Hey everyone, and welcome back to the channel where we deep dive into the fascinating world of how to borrow stocks and potential short squeezes. Today, we're putting a spotlight on a company that's been flashing on our screen due to its incredibly high cost to borrow, Global Interactive Technologies Inc., ticker symbol GITS. We're going to break down exactly why this stock is hard to borrow, what that means for investors, and what to watch for. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's start with a quick overview of GITS, Global Interactive Technologies Inc. Show GITS logo/stock chart. This company, operating primarily in South Korea through its subsidiary, is a technology-focused platform in the communication services sector, specifically internet content and information. They operate and develop Filing, a digital fan engagement platform designed to support online fan communities, content discovery, and user interaction. Currently, GITS has a modest market capitalization of about $8 million. Looking at recent price action show chart with price trends, GITS has seen some interesting movement. It's up plus 1.88% today, gained plus 4.83% over the last 5 days, and a significant plus 46.62% in the past 30 days. What's cost to borrow and why it matters? So, what exactly is cost to borrow, or CTB, and why should you care? Share animation of short selling process. When an investor wants to short a stock, they first have to borrow shares from another investor, typically through a broker. They then sell those borrowed shares, hoping to buy them back later at a low price and return them, profiting from the difference. But borrowing shares isn't free. There's a fee and interest rate that short sellers pay to the lender, known as the cost to borrow. This fee is usually expressed as an annualized percentage. When this fee skyrockets, it's a huge red flag for short sellers. It tells them that demand to borrow shares is extremely high, and the supply of available shares is very low. High CTB means holding a short position becomes very expensive, very quickly. It's not uncommon for these fees to exceed 100% annually, which means a short seller could pay back more than the initial value of the stock just in fees if they hold their position for a year. Why this stock is hard to borrow right now? Now, let's talk about GITS specifically. This stock appeared on our hard-to-borrow screener for a very compelling reason. Its annualized cost-to-borrow fee is a staggering 932.3%. Highlight CTB number. That's almost 10 times the value of the stock annually just to hold a short position. This tells us there's immense demand from short sellers to bet against GITS, but crucially, very few shares are actually available for them to borrow. The estimated float for GITS is just 2.4 million shares. When the available shares to borrow become scarce, and the CTB fee rockets like this, it can put short sellers in a very precarious position. If the price starts to rise, they face not only unrealized losses on their position but also the crushing burden of these incredibly high borrow fees. Our internal composite squeeze score for GITS, which considers CTB, borrow supply, float, and momentum, sits at 42.5. Squeeze mechanics explained. This brings us to the mechanics of a short squeeze. Show squeeze graphic. Imagine short sellers are bleeding money due to high CTB fees and a rising stock price. At some point, many of them will be forced to cut their losses and cover their short positions. To cover, they must buy back the shares they initially sold. This buying pressure, initiated by short sellers, further drives up the stock price. This rising price can then trigger more short sellers to cover, creating a positive feedback loop of short squeeze. It's important to remember, though, that a high cost to borrow does not guarantee a squeeze. Sometimes short sellers have extremely high conviction that stock will eventually go down, and they are willing to pay those exorbitant fees to stay short. This is why a balanced approach is crucial. Dilution risk check. One major factor that can completely negate a short squeeze thesis, even with high cost to borrow, is dilution. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. While this can raise capital for the company, it also spreads the company's value across more shares, effectively lowering the price per share. For a short squeeze, new share issuance can flood the market with supply, making it easier for short sellers to find shares to cover and dampening any buying pressure from short covering. So, what about GITS? We checked for recent diluted SEC filings like SMINUS1, SMINUS3, or 424B over the last 90 days, and we found no recent diluted filings. That's a positive sign for any potential squeeze thesis, as it removes one significant headwind. We also found no recent reverse splits for GITS in our look-back window. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what should you be watching for with GITS? First, keep a very close eye on the cost to borrow fee. Any sustained increase or decrease will be a significant indicator. Second, monitor the shares available to borrow. If that number remains extremely low or dries up entirely, the pressure on shorts intensifies. Third, volume. This is crucial. While GITS has had a significant run over the past 30 days, seeing a plus 46.62% increase, today's volume was surprisingly low at just 17,087 shares. That's a stark contrast to its 30-day average volume of 1,338,842 shares, resulting in a 0x relative volume for today. Highlight volume discrepancy. For a true squeeze to occur, we typically expect to see a surge in buying volume, not a significant drop like today's. You'll want to see if trading interest picks back up and volume returns closer to its average. And finally, given GITS' small $8 million market cap, it's highly susceptible to significant volatility. Small amounts of buying or selling pressure can have a magnified impact on the share price. Global Interactive Technologies Inc. GITS presents an intriguing case with its sky-high 932.3% cost to borrow fee and a relatively small estimated float of 2.4 million shares. While the recent price action has been positive over the past month, the exceptionally low volume today is a point of caution to consider. This isn't a guarantee of a squeeze, but it certainly puts GITS on the radar for those interested in understanding hard-to-borrow dynamics. Always remember to do your own thorough research and understand the risks involved. If you found this breakdown helpful, please hit that like button, subscribe for more in-depth analyses, and let us know in the comments if there are other stocks you'd like us to investigate. Thanks for watching, and we'll see you in the next video.